Welcome to the Broken Pie Chart Podcast, episode 153. I'm your host, Derek Moore, and this week we're going to be talking a little bit about the indexes and valuation. And there's some quirks in how the Russell 2000 does its valuation, or should I say the PE ratio, compared to the S&P. And I'll also explore, back in 2009, Professor Jeremy Siegel had written an article that said the S&P gets its earnings wrong. So I'll kind of dig into that again because someone had sent me a note this week about how the Russell 2000, their PE was lower than the S&P. And there's actually a little nuance to that. So we'll get into that and help you with those things. And also a little bit of an update on the market. Obviously this week, year to date now, let's see, as of Friday's close, which was the 27th, the markets were down about 9% now for the year. They were down as bad as 10%. And that's the S&P. The NASDAQ is down a little bit more. Interesting thing, though, I was just looking back at a chart from JP Morgan on their guide to the markets and just looking at some of the intra-year declines versus the annual returns. And last couple of years, we've had 27%, plus 16%, plus 29%. You have to go back to 2018, where we had a negative 6% return. And I think this is, does not include dividends. So the total return would be better than that, as the same way that last year's 27% is higher when you look at a total return basis. But what's interesting is, you look at this year, so we had a negative 10%, and it's been some time since we even had a retracement of 5% or more. 2021 was sort of an odd year in that regard. But then you look and you say, okay, we were up 27% last year. Intra-year, we got down minus 5%. The year before, of course, was 2020. We had the government shutdowns, GDP growth cratered, but we reached negative 34% on a price basis, not a total return basis. So if you're listening to this and you're thinking, wait a second, I think your numbers are off. It does not include dividends. So down 34%, wind up 16% up. 2019, down 7%, wound up 29%. And 2018, we were down 20%. Remember that? It was towards the end of the year. I think the worst day was actually Christmas Eve, and the market started to make its way back up from there. But a decline of 20%, wound up negative 6%. And I even go back to 1987. Market was down minus 34 at one point, which is really interesting because that's exactly where it stopped in 2020. And it's actually where it stopped in, I got to think of the year, 2000 to probably 2002. It actually stopped. There's something about that 34%, although we did go down 49% on the S&P in 2008, of course. My point of sharing this with you is that if you look, there is volatility every year. Some years are more volatile, other years aren't. And if you look at the intra-year declines and then what the market winds up at, the market tends to not pin itself to the number. I mean, 2008 was probably the closest, minus 38% versus minus 49% at the worst. But you're going to have volatility. And this, again, is why I continue to talk about just being invested at the market. Jay Pestrcelli and I did that podcast. If I remember which one it was, I'll post it in the show notes, where just missing the two best days of the year over a 20-year period, hypothetically, of course, right? Not real returns, but hypothetically, your annualized return, I think we said, would go down from like 8% compounded growth rate down to under 2%, just missing the two best days of the year. So this is why, again, the idea of being invested but being hedged, having a floor in portfolios, because imagine if you panic and you get out every time the market is down quite a bit. As Jay likes to say, have you ever made a good decision when you were panicked? But we'll see what happens. I know it sounds weird, and I say it again and again. We don't know what the market's going to do. All we do is we get invested and we manage the risk. The risk is what you can try and manage. The rest is, as they say. Anyway, by the way, if you want more information on that, make sure and email me. And by the way, I do enjoy the emails, and a lot of these topics that I cover. Before we get into things, I'll just give it to you again. It's derek.moore at zegafinancial.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple, financial.com. Financial is up to you to spell correctly. Okay. So the question this week came about from someone who had I don't know if they read a research piece or where they got it. And they kind of said, well, small caps are really cheap right now. And and by the way, I mean, after the declines this week, the S&P on a forward-looking basis, remember, forward PEs are looking at the value of the index over the analyst projected earnings over the next 12 months. And so we were sort of, higher, right? Just kind of looking back on things. The PE got up, I think around 23 or so, the forward PE, and it's come down. It's now 19.19. So the S&P is trading at 19.19 times next year's forward earnings. But the question that came about was this idea of small caps being really cheap. And look, that may be the case. It may not be the case. I don't try and pick indexes or markets. And the link that they sent me was from the iShares Russell 2000 ETF, symbol IWM. And their PE ratio as of January 27, 2022 was 17.61. So the PE ratio, that's going to be going back, four quarters. But one of the nuances of how the PE is calculated, and if I'll put the link to I'll put the link to it if I remember. The price to earnings ratio, there's a little I for information, and if you go there, it says the price to earnings PE ratio is tells you what it is. And it said negative PE ratios are excluded from this calculation. Negative PE ratios are excluded from this calculation. So what does that mean exactly? Well, Sibelius Research, I'll put a link to them as well. They calculated as of the end of December, so it's December 31st, 2021. So roughly, it's not roughly, it's 28 days ago. They had the PE of 94.98. And in their explanation, when the price to earnings ratio is calculated, also negative earnings have been taken into account. So what you're seeing here is a little nuance. And if companies have negative earnings, they actually do not use those in the computation of the PE ratio for the Russell 2000. They do use it in other indexes. I know the S&P does. I'm assuming, although I didn't check, I believe the NDX 100, NASDAQ 100, they if a company loses money, that's included. And so when you look at, I don't want to call it a true PE ratio. And to be fair, Russell on their site or the iShares ETF, they disclose it right on there. But if you're just looking and you say, well, that has a 17 PE and the S&P has, I said the forward PE 19.2, but I think trailing was more like 23, 24. And you look at those two, it seems like, oh, one is much cheaper on a PE or evaluation basis. Again, I'm not saying one is cheap, one is not. But when you look at the PE ratio, so 94.98, June of 21, it was negative, meaning the index aggregated all of the income data from every company in that Russell 2000. They had negative earnings. And then you go back, I don't know, end of 2018, the PE was 40.17. So again, I'm not saying one is cheap, one is expensive. Don't buy or sell anything based upon what I'm telling you here. I just want you to be aware that the methodology on those indexes are a little bit different. Now, this brings me back also to, I remember there was and I pulled the article. I'll see if I can link to it. This is February 25th of 2009. So hard to believe that's, what is that, that's like 23 years ago. Really? No, was it? No. I'm adding too many days. 2010, 12. It's 13 years ago. All right. So the title of the article is S&P Gets Its Earnings Wrong. And what Siegel said was, and his argument was, so back then, he wrote the book Stocks for the Long Run. He's written a couple different editions. And people have accused him of being permanently bullish. Like, it doesn't matter what's going on. He likes stocks. And in his book, he makes the case, and he goes back many, many years, that stocks for the long run have a much higher compounded real compounded, so after adjusted for inflation, compounded growth rate than anything else, like bonds, gold, U.S. dollar, which of course has lost purchasing power year after year due to inflation. But what he says was, and I'll quote here. Let me just not read too much of this. The bizarre way in which S&P and most other index providers calculate aggregate earnings and PE ratios for their indexes. Unlike their calculation of returns, S&P adds together dollar for dollar the large losses of a few firms to the profits of healthy firms without any regard to market weight of the firm in the S&P 500. If they instead weight each firm's earnings by its relative market weight, identical to how they calculate returns on the S&P 500, the earnings picture becomes far brighter. So basically what he's getting at is indexes are market-weighted index. So the Dow Jones actually weights their companies based on price, which is, some people have said that maybe they should rethink that, because if a company splits its stock 2-for-1 and its price gets halved, just doing that causes a change to the weighting in the index. But for example, Apple is the highest weighted stock in the S&P 500. And so if that goes up or down versus a stock that is a really tiny weight, that's going to have a much bigger impact on the price of the index. And in Siegel's article, he uses Exxon. Oh, that's interesting. Exxon was the highest rated stock back then, highest weighted stock, not rated, weighted. And his point was, he says, hey, let's look at Exxon and let's look at Jones Apparel. That was the smallest stock in the S&P 500 index. I don't know what Jones Apparel does, but back in 2009. And he said if you used, essentially what he's saying is, if they did the price changes the same as earnings, everyone would have the same weight. So he said, hey, if ExxonMobil rose 10% in price and the smallest stock, Jones Apparel, fell 10%, would the S&P report the S&P 500 was unchanged? No. Back then, Exxon had a market weight of over 5%, while the weight of Jones Apparel was less than 0.04%. So the point he's trying to make is that when you have, and this happens when you have really bad years, because a lot of companies write off stuff. It's a chance to, hey, that project that we did, and I'll just write it down on the accounting side, and I'll take a charge. So you saw that a lot with, back in 2008, 2009. I actually expected to see more of that in 2020. But it's kind of like, and I say this sarcastically, but if a CEO wants to put out a bunch of bad news, like a bad market gives them an excuse to do that, an opportunity, where in a really good market, they don't want to mess up the earnings. Anyway, so what he's saying is that, hey, if you have a bunch of companies that maybe lost some money but they're not weighted as high as the other stocks, they sort of can mess up the earnings. I don't know. I mean, there's people who have, and there were a bunch of articles at the time who were kind of saying, well, it doesn't really make any sense. Just to kind of give you a different view on this, at the end of 2021, the market cap on the S&P 500 was about 42.4 trillion. So the market cap meaning the price times all of the shares of every company that's in the S&P 500. And that's the market cap. But we know that the index, when you look at the S&P 500, the other day it was around, it was 4,300 or so. And 4,300 is not, you shouldn't take that because you're like, oh, 42.4 trillion or 42.5. Did they round it? Did they not? No. So the index value isn't like, oh, 42 trillion, 400 billion and change. They actually use a divisor, and they weight all the companies based upon market cap. So Apple has a higher weighting in the index than other companies. And they use this index divisor to keep the index. And they use the index divisor because if a stock splits or another company comes in, they try and really keep more of a smoothed. They don't want jagged things to happen to the index value, and also it goes back to when it was created. But anyway, so back to this. So 42.4 trillion is the S&P market cap, and their earnings were roughly around, I don't know, I think I estimated this about 1.8 trillion. Now, you probably see when there's earnings estimates, they always do a per share basis on the S&P. And that gets a little bit complicated. I mean, yeah, you could kind of say, I could take the market cap divided by the earnings, or I could take, the earnings or the aggregate earnings of all the companies, what they make, what they lose, sum them all up together. But the divisor does come into play with the earnings per share. So it's not podcast worthy. It's I'd have to use I'd have to write this up. But my point of saying this is that the S&P 500 uses every company's earnings, whether they're positive or negative, and that's what they use. And so their PE ratio is based upon those numbers. And of course, the per share base, as I said, that divisor comes in there. And as of the end of the year, the PE was about 23, the trailing PE. They don't, on the S&P site, I don't think they update the forward PE, but we know from the JP Morgan data, it's about 19.2. So, all right. So what does this tell us? Well, maybe nothing. Maybe now, next time, you see someone saying, hey, I think such and such is really overvalued, undervalued. Now you know the difference in those two indexes. All right. A few other things worth noting, and we've been talking about inflation and the idea of it's been a supply side issue. We've talked about the backup at the ports, things like that. There was an interesting, kind of flies under the radar, but it has to deal with inventory. So the change in private inventories, and so this isn't adjusted for inflation, was sort of the highest change going back to 1950. Again, not adjusted for inflation, seasonally adjusted, but not adjusted for inflation. Q2 of 2020, the lockdown quarter, that was actually the lowest one. But it just was of note because we've been saying that one of the things that's been challenging is, and one of the benefits is the idea that corporations or companies or stores need to reload their inventory. Inventory levels were very, very low. And so I thought that was interesting that Q4, and I'm not sure how that was spread out over the months, saw a pretty big rise in a change in inventory levels. And if you adjust it for inflation, we actually were higher back in Q1 of 2015. But this was certainly a pretty big jump in inventories. And that was one of the reasons why GDP, which was the first advanced estimate of Q4 GDP, one of the reasons why that was so high was because of the change in inventories. I think I saw something that close to, what was it, 6-7, I think, was the beat on GDP. But this jump in inventories accounted for almost 5% of that. Now, some people might look at that and say, well, that's if that goes away. But remember, that's they would contribute something as long as it was positive. They contribute negatively to GDP growth if it's negative. But I just thought that was an off the radar thing, and I know we've been talking about the inventory levels. And I would just comment that this is one of those things I just thought was interesting, and it's one to watch as we go through this supply chain issue. And as we've said, we think with the upcoming Federal Reserve actions, we're not convinced that raising rates is going to ease inflation, because it is, in my opinion, more of a supply side issue. And by the way, inventories, those can be any number of things along the supply chain. They could be finished goods, works in progress, and I'm reading right off the government site, materials and supplies inventory. So this is one I'll be watching. It's one of many, and so I thought I would share that with you. Well, I think that's going to be it for now. Like I always say, rather than rating, starring, reviewing, if you want to rate and star and review and do all that stuff, please do that. Only 5 stars, though. Don't leave 1 star. Those are no good. Also, send emails, derek.moore at zegafinancial.com. And as I say, it's Derek, derek.moore at Zega, Zega, C as in zebra, E as in Eddie, G as in George, A as in Apple, financial.com. Financial's up to you. And the offer still stands. If we get an actual listener from Gibraltar, I will send a signed book out, but it's got to be a Gibraltarian address. Why Gibraltar? I don't know. It's on a country that we don't seem to have had a listener in yet, but there's still hope. All right, folks, we'll talk to you next week. Take care.